Lesson 5, Trends and Trend Lines. Before we get started, I'd like to point out a couple things. Number one, at the very bottom center of this page, you'll see a number. That is the number of the slide that comes up as I click forward. In your workbook, that same number is there. If by chance you get lost along the way and you don't know what slide we're on, just look at that number and compare it to the number in your workbook. The second thing I'd like to point out is up in the top left-hand corner, I have a sign that says important information. You will see this sign appear on certain slides and in your workbook. Whenever you see that sign, that information that's on that page is real critical, and it really is somewhat of a trader's tip that can participate in helping you become a better trader. I would also like you to take the time to please read this so you that understand what trading is about. There are 16 lessons on trading the Forex. They focus in on technical analysis. Technical analysis is the study of chart reading that can participate greatly in helping you. We focus in on the Forex. A lot of the exercises in here are on the Forex. However, there are some exercises on stock charts as well, because technical analysis is applicable to all charts. I heard this statement a long time ago: successful traders will do what unsuccessful traders can't and won't do. Now, if you really think about it, the only difference between you and a very successful trader is they know and can do something that you can't do. However, what they do and what they know, you can learn to do. Change the word traders to people. Successful people will do what unsuccessful people can't and won't do. I've learned in my experience and in my business career and in my trading career that success is a habit. Success is a discipline. Success is something you learn, and then you become disciplined at being successful on a daily basis. You are successful because of your disciplined habit that you learn. Learning to trade will become a discipline. It will become a technique that you will learn to execute, and you will need to be disciplined in executing that technique. There is a 21-day 3% rule. What does that mean? It means that the human mind forgets 80% of the knowledge it acquires within 3 days. Over the next 18 days, it continues the loss of information until it settles at retaining only 3% of the original acquired information. Take this CD or video and re-watch it over and over and over again until you understand what you need to know on how to trade trends and trend lines. By the end of this lesson, you will understand that the markets can only move up, down, or sideways. That's all they can do. You will learn how to read a trending trading chart and be introduced to the technical side of dealing with a trend. You will learn how to find and draw 3 trend lines: the inner, the outer, and a long-term trend line in an uptrend as well as a downtrend. You will learn how to find a trade in an up or down trend, create a trading plan, and financially protect yourself in every trade. You will learn how to spot the end of a trend. Before we get started, let's review reading a trading chart and placing orders. We watch Japanese candlesticks. They monitor the open, the high, the low, and the close of a time period. They're bullish candles and bearish candles. Bullish candles signify hollow candles or white candles. They go up. Bearish candles signify candles that are going down. The market is going down in price. They are the black candles. The market doesn't go up and it doesn't go down. It is constantly going up and down, constantly on the move. We are also watching a bid chart. The prices that you see, the current price, that is the bid chart. There is a bid and an ask. The ask is usually 3 to 10 pips higher than the actual bid chart. If I was to have an ask chart up here, it would look identical to this candlestick chart. It would only be 3 to 10 pips higher than this bid chart. The difference between the bid and the ask is called a spread. Trade products with tight spreads. Do not trade products that have huge spreads. A lot of people think that trading penny stocks is just easy because the stock only costs a penny or a nickel. Sometimes the spreads are 100% on penny stocks. You buy a stock for 10 cents and you want to sell it, and they're only offering 5 cents to buy it. So the bid and the ask can be as much as 100%. The ask is 10 cents, the bid is a nickel. So spreads are very important. In the currency market, there's 3 to 10 pip spreads. If you don't understand this, please feel free to call our customer service line and we'll explain that to you in detail. We buy on the ask and we sell on the bid. So keep that in mind. We're always buying on the ask and selling on the bid. The ask price will always be higher than the bid price. Envision an auction. When we're at an auction, the ask price, we're always asking more. If I was selling a pin and asking $10 for it, you would probably bid $5. That difference is called the spread between $5 and $10. That's the spread. But see how the ask price is higher than the bid? Keep that in mind. So when you're buying, we buy on the ask, which means if this is the bid price and that's the current price, if I was buying at the market, I would be buying at 107.35 because I'm buying on the ask. The ask is about 5 pips higher. So when I place my sell limits, I would be selling on the bid. Whenever the market rallied and the candlestick hit that price, that's the bid price. Or if the market fell and hit my stop order, whatever number was there, since I'm selling on the bid, when this candlestick hit that price, my order would be executed or filled. Conversely, I sell on the bid. So if I'm selling and entering the market at the market right now, I'm selling right now at 107.30. That's the bid price. If the market rallies and goes up to here and I have my stop order at this last high, the ask price will hit that stop order way before the bid price will. And many traders get confused. Whenever the market rallies, they see that the candlestick did not hit their stop order, and then the market rallies, comes up, U-turns and falls. The trader's sitting there glad that they weren't stopped out, yet the ask price hit it and they were stopped out. Please understand this to avoid a lot of confusion. The same applies on when you buy below the market. It's a limit order and you buy on the ask. So keep that in mind. Types of orders: we deal with a market order, which is an order at the market. We deal with a limit order, which is an order above the market or below the market. You can place in a stop order. These are orders that are placed at specified prices. If you have any questions about these, please give our company a call or review in detail Lesson 1, which goes into detail about the market, limit, and stop order. Whenever you buy above the market, that is a stop order. When you sell above the market, that is a limit order. When you buy below the market, that's a limit order. When you sell below the market, that's a stop order. If the market is here, any order you place above the market is called a working or open order. It's an order that's not filled. Any order you place below the market is an open or working order, an order that's not filled. These are the rules of trading. You just got to understand them. Ordering rules: for every buy, you need to have 2 sells, one for protective loss stop and one for profit. Let's just say the market here has broken the trend line. You enter the market's sitting in the buy zone. A great lesson on buy and sell zones is lesson 6. You place your order at your stop order at the last low. Market You enter the market buying on the ask. You place your stop order, last low, market continues to rally, there's your profit. You have a buy with 2 sells. Conversely, every sell should have 2 buys. Whenever you're selling or shorting the market, you want the market to go down, you're a bear, your position is short, you're trying to profit as the market is dipping and falling. You need a buy order for profit. When you buy below the market, it's a limit order. When you buy above the market, it's a stop order. These are the rules of trading. Let's look at this chart. Market breaks the trend line, enters into the sell zone. You enter the market. At the market, you sell on the bid. You place your stop order at the last high, and then the market falls. For every sell, you need 2 buy orders, your buy stop loss order and your buy limit order. So OCOs are an order where you can set it and forget it. You find for whatever reason, let's just say you're looking at stochastics, PCI, a trading indicator for that matter, and it gives you a buy signal. You enter the market buying. Whenever you place an order to buy, every buy should have 2 sells. You place an order to sell for profit, an order to sell for potential loss. You can set it and forget it. Whichever the market hits first, it will cancel the other order. OCO, one cancels the other. Cancel and replacing. Please go to lesson 3 on equity management as well as lesson 16. It teaches you how to properly cancel and replace, but if you were to enter buying the market and you wanted to chase the market, your stop order would be at the last low as the market rallied. Do not cancel and replace your order to the last low until the market has taken out the new high. So if you were to cancel or replace your order from here up to here, you cannot do that until it has reached here. So as the market retraces back, creates a low, and rallies, takes out the previous high, now it's time to move from here to here. Market retraces, establishes a low. At this point in time, when it takes out this high, is when you can move your protective stop loss order from here to here. As the market retraces back a little bit, U-turns, takes out the high, now you can move it from here to here. As the market rallies, retraces back, and U-turns and takes out the high, now you can move it from here to here. The same applies in a downtrend. Do not cancel and replace until the market has taken out the new low. So only cancel and replace to the new last high after the market has made a new low. You enter the market here, your stop order's there. You can cancel and replace to this high when the market takes out this low. So you would go from here to here. As the market bounces here, U-turns, takes out the low. Now you can go from here to here. As the market comes down, takes out that high, or bounces, U-turns, takes out the low. Now you can replace it from here to here. Keep trading, canceling, replacing, locking in profit until you've been stopped out. This is not a greedy way to trade. This is a very educated way to trade. Bulls want the market to go up, and bulls buy low and sell high. So for whatever reason, in this shot here, there's a trading indicator that is giving off buy and sell signals. Bulls buy low, sell high, buy low, sell high, buy low, sell high. Bears do the opposite. They sell high and buy low. Now think about it. A bear thinks the market's going to fall. The greatest part about trading currencies is whether the market is rallying or reacting or falling, you can make money. Once you learn how to short the market, you can make money by selling first and buying second. Now, if you sell first and the market falls and you buy second, did you buy low and sell high? Yes. If you don't understand how to short the market, feel free to call us. We'll explain it to you in detail or review lesson 1. It focuses in on shorting the market and explaining. Once again, if you sell a product for $107 but you bought it for $104, did you make any money? Yes, you did. You made $3. So Learn how to short the market. It offers great potential in the currency market. Technical traders learn to read charts. They read charts like doctors read x-rays. To the trained eye, charts are telling a story. Technical analysis gives traders a high probability of knowing where the market is going. So the education is well worth it. A chart is a chart is a chart. Technical analysis is applicable to all markets and anywhere you can pull up a chart. Once you've been educated on how to read a chart, you will start to control your financial future. This lesson requires a review of support and resistance. Remember that a high is 2 to the left, 2 to the right. You have 2 candles to the left that are lower than the either candle or wick high, and 2 candles to the right that are lower. Remember that not all highs are levels of resistance. Only higher highs that are being created are new levels of resistance from where the market is currently trading. Lesson 2 goes into detail about this. Lows have 2 candles to the left and 2 candles to the right that are higher than the wick or body of the candle low. That signifies a low. Not all lows are levels of support. Once again, please refer to Lesson 2 to understand support and resistance. Be that as it may, here's where the market is. One of the things you need to get in the habit of doing is before you trade, go and find all your levels of resistance first, all your levels of support, because this is a financial game. Whoever takes control of the market, the bulls, if they take control, they are going to try to achieve new highs. These levels of resistance become milestones. They are going to try to take them out, meaning they'll try to rally and make a new high and take out resistance 1, resistance 2, resistance 3, resistance 4. Conversely, if the bears take control, their milestones are support 1, support 2, support 3. They'll probably take this market and take it down and take out all levels of support. That is the financial game. So don't underestimate that game. The best way to understand what you've learned is to write down what you think you know. Then go back after you have been taught and look at what you have been taught and now what you know versus what you thought you knew. Your perception is your reality. Write down what you see and think you know about trend lines. Now you can clearly pause your machine and go ahead and try to find what's called inner, outer, and long-term trend lines. And then we'll see what you know at the end of this lesson. Draw your inner, outer, and long-term trend lines. This is a daily chart. Trend lines are applicable on all charts. This is a Japanese 4-hour chart. Pause your machine and draw the line. This is a Euro 1-hour chart. Pause your machine and draw your trend lines. This is Microsoft. It's a 2-hour chart. I've used a variety of charts just to show you that trend lines are applicable in all charts. This is a stock. Pause your machine and draw your 3 trend lines. This is Dell stock. Pause your machine and draw your 3 trend lines. Let's get started. Trends and trend lines. An uptrend. Well, it all begins with a price swing. As the market moves, it waves. And those waves are called price swings. Uptrend price swings start at the low and stop at the high. They start down here and stop at a high. Whenever you now have a confirmed low, that's the beginning, and a confirmed high to the left, to the right, that's the stop. Let's look at this. This is a up price swing. Look at how 2 to the left, 2 to the right, 2 to the left, 2 to the right. It comes down, finishes off with a tweezer bottom. Lesson 11. really focuses in on trading candlesticks. It's a great lesson. Creates a tweezer bottom here and ends the swing. Another one starts up. So uptrends. Uptrends is when the chart is establishing higher highs and higher lows via price swings. Look at this. See how this high is higher than this high, and this high is higher than that high, and this low is higher than that low, and this low is higher than that low. Let's look at this chart. See how it's making higher highs and higher lows? See how this low is higher than that low, and that low is higher than that low? Higher highs and higher lows is called an uptrend. This is another chart making higher highs and higher lows. This is another chart making higher highs and higher lows. This is what an uptrend looks like with an indicator. See these indicators giving off buy and sell signals? Please go to lesson 4 on trading indicators. Market Traders has some great indicators as well. Keep in touch with us. We will teach you the latest indicators on our software. They can be very helpful. This indicator showed you to get in here that this downtrend was reversing, and now a new uptrend here became the buy. Look at all this profit being made via this indicator. When you spot an uptrend, you will draw your trend lines across the lows. Now let's look at this uptrend. Here, look how we drew our trend line across the lows. So there are incorrect ways to draw trend lines. Why is this way incorrect? Well, remember, as long as the market is making new highs, you will draw your trend line across all the lows. In drawing your trend line, your outer upward trend line, you will start at the left of your chart and go across all the lows, moving from left to right. This is the correct way to draw your outer upward trend line across the lows. Let's look at this chart. This is the incorrect way to draw the trend line. At one time, this was the correct way, but look at how the market is achieving higher highs. We're still in an uptrend. The fact that we're still in an uptrend, this becomes the correct way. We start at the left of the chart and we draw it across all the lows. Now, this is the incorrect way to draw the trend line on this one. Why? Because the market is no longer making higher